Friday's credit downgrade from Moody's does highlight the growing concerns around the issue of US debt right now. The deficit continues to grow. Donald Trump, of course, wants to grow that even more, considering his spending plan that is trying to pass through Washington. And so with markets in the red and certainly the topic at the forefront of the investor mindset right now, let's deep dive into it and gauge exactly what assets might gain or might suffer as a result of this current growing debt phenomenon in the US. So as we can see, first and foremost, this is the headline. It came out on Friday and we saw Moody strip the US of their AAA credit rating. Now, this is the first time in history that they've done so, but that doesn't mean it's the first time in history that the US have lost their AAA rating, because in actual fact, Moody's were the last ones to actually maintain that rating. And you can see that here. Moody's, the S&P 500 and Fitch, now all three of them providing a AA plus rating to the US and removing that AAA rating for good reason, right? The country is massively reliant on debt, and that debt pile continues to grow. They're doing very little to be able to minimize or lessen that debt. And certainly, just like an individual, if you're just continuing to borrow on top of borrowing and that debt pile continues to grow, you're not necessarily a great client. You know, if you're going to get a mortgage and you just show someone a whole stack of debt that you've got and income that doesn't necessarily cover that debt, then essentially you're not in a great position. You're unlikely to be able to take on more debt. The US has been in a position where, of course, it has an enviable position in terms of the amount of growth it has, the fact that people see it as a reliable source of growth, and therefore this US exceptionalism story has played out. People want to put their money into US assets like equities. People are happy putting their monies in US treasuries because they think that they're the safest place to be when it comes to the treasury markets, despite the fact that, of course, they do have a ballooning debt issue. But this year, of course, under Donald Trump, that US exceptionalism story started to unwind somewhat because people are starting to question whether the US is indeed a reliable partner. Now, that concern has eased somewhat with the fact that they have reversed many of these reciprocal tariffs for 90 days, I might add. But certainly it is really raising the question of whether countries are likely to continue to funnel money into US treasuries this year. So let's look at some of the key things to sort of concern ourselves with this issue. First and foremost, here is the picture for US debt. And what we can see is it's massively ballooned over recent years. A lot of that's come down to the pandemic. Of course, certain countries in the world, I remember going to Colombia, they didn't have this kind of situation where essentially during the pandemic, people just had to fend for themselves. But here in the UK, in the US, it was a case of dishing out money left, right, and center. And that money had to come from somewhere. And invariably, that just meant more and more borrowing, right? So we've seen a ballooning in terms of the debt, a ballooning in terms of the interest payments. So between the federal and the state debt, they're essentially having to pay over $1 trillion in interest payments per year to be able to sustain that. So it's just growing and growing. And unless they manage to drive down the debt, it's only going to get worse. So you might pay, if you live in the US or in the UK and many other countries, you might pay your wage thinking that that is going to go towards public services. You know, maybe they're going to do up my road around the corner that's got potholes. Well, a lot of that's not going to do that. It's going to just pay the interest on the debt that they've already taken out. The US debt to GDP ratio has, of course, climbed over the years. It's not necessarily a new phenomenon, but there's a perception that under Donald Trump, that is going to grow even further. He wants to raise spending. He wants to cut taxes. And so when you're looking at debt to GDP, it's a question mark of the debt side versus the GDP side. We've heard from Scott Bessent, who's essentially said, well, it's fine because we're going to grow the GDP figure to a point where that's what keeps a lid on US debt to GDP, right? So sometimes you have countries that are too fearful to take on the new debt because they can't guarantee that they're going to be able to get strong GDP out of that spending. Whereas the US, you know, under Donald Trump, are very confident that they can just spend more and therefore they'll be in a position where the GDP figure will grow with it as well. But that GDP figure is going to have to get pretty high, and it's questionable whether they're going to be able to reach the levels needed to be able to maintain it at this current threshold. The deficit to GDP investments come out and said, look, we took it over from Biden. It was 6.5%, the highest deficit in a non sort of recessionary period, essentially, or crisis period. But nonetheless, the Moody's report pointed towards in the next 10 years, that figure is going to be more like 9%, as you can see here with the sort of dotted line. So in the next 10 years, it's just expected to grow and grow, the deficit. And so really that provides a theme around the instability financially of the US, how they're going to fund these treasuries. Many of these treasuries are rolling over, and that's something we'll talk about. And part of it has been about cost cutting, right? So the US is very wasteful in a number of areas, and therefore in comes Elon Musk. And, you know, we're on an unsustainable debt pathway he was talking about. So he looked to come in, and he was pledging $2 trillion of savings. Well, that then got revised down to $1 trillion, then 160 billion estimated here as the estimated savings under the Doge team. So nowhere near what was pledged in the first place, and ultimately something that, you know, it's welcome, certainly if they've found a number of places where there's wastage. But bearing in mind, you can cut a lot of jobs, but many of these jobs, it's just subjective about whether they're needed or not, right? It's understandable if there's payments going out to someone that doesn't exist. A lot of the time they're just saying, oh, you know, this team could do without this manager, or some of these different roles. It can get rolled into a different department and things getting moved around. But a lot of the time they're having to pay people off in the first place to be able to get rid of them. And so some of those actually come with higher costs a lot of the time. So it's not necessarily a case that they're saving huge amounts of money that's actually going to be able to make a dent on the debt trajectory that the US is currently on. So one of the problems here is the fact that right now, Donald Trump is trying to push through what he calls the big, beautiful bill, right? And that has a number of different parts that go into it. One element is going to be maintaining the tax cuts from 2017 going forward, and tax cuts for businesses, potentially tax cuts for some individuals, a pledge to raise spending in certain areas, notably in defense. And so you're looking here in terms of the outlook for the deficit and saying, well, actually by financial year of 2027, the deficit's going to be 1/3 larger than it would be otherwise if that bill wasn't passed. So essentially, markets essentially having to weigh up these two things, right? So on one side, the market's like, great, if we get tax cuts, then all these businesses are going to have better margins because they have less outlays in terms of their expenditures, and they're going to be able to have better profits. It's good for the S&P 500 and the like. That's weighed up against the fact that the debt grows by even more, and therefore you're looking at the possibility that they're going to have to pay more and more per year to be able to maintain that debt. The argument also is, well, in actual fact, you're going to see so much more growth that we may be charging them less tax on if it stood still. But if it grows more, then you're taxing a bigger number. So you might actually get a bigger figure than if it stood still. But again, that's relying on GDP. That certainly isn't a given. One of the hot topics coming into this year has been the fact that they have a huge amount of debt that is rolling over in 2025, some $7 trillion of debt that needs refinancing. And so a lot of the time at the beginning when Donald Trump came in, there was this talk of he's trying to crash the economy because he wants to drive down the cost of borrowing. And therefore, he's going to roll over all this debt and look like a genius because once all of this debt's been refinanced at a lower rate, then he'll move to essentially rescue the economy, and they would have done the job, essentially pushing people into haven assets such as treasuries, driving down the yield, and therefore they won't have to pay out so much for those treasuries, and therefore rolling over many of these treasuries in this crucial year between 2025, 2026, absolutely key area in terms of the refinancing of this debt. Bear in mind, though, if you look further out, it's notable. You might think, why have we got so much debt in the near term and not necessarily in the future? It's worthwhile noting that like debt can come in different formats in terms of duration. So some of that debt might be long-term in nature, and you're going to see that in the back end of this chart, right? And some of it will be short-term in nature. So once you get closer to that debt, so let's say when we're in 2030, then the 2031 figure is going to be a lot higher than it is right now, because you would see, say, 5 years in there, 1 year, 2 years, and then they all sort of roll into it. So the current year is always going to look relatively large, but this is a particularly large year in terms of the refinancing of debt, a huge amount of debt. They need to find buyers for that debt. And the question mark is it going to come internally or is it going to come externally? And as Donald Trump burnt bridges to the extent where the external demand isn't necessarily going to be there in the same way. And you can see that here. Who owns US treasuries? Well, 33% of that is the rest of the world. And so it's crucial to have that demand from around the world. You can see here the likes of the government, the financial sector. So there's a lot of demand internally within the US, but there's also a lot of demand, 30% of that coming from the rest of the world. So if you're talking about just in 1 year, need to find a home for $7 trillion worth of debt, well, over $2 trillion of that is going to have to come from the rest of the world. And right now, people are questioning whether the US is super sustainable. And that's where the Moody's downgrade comes in, right? So if Moody's are downgrading them and saying they're not necessarily a super perfect credit-worthy country to deal with, then that to some extent might sort of weaken the hand of the US when it comes to going to market and trying to sell their debt. At the same time, look at what happened with Canada and the US, right? The Canadians were saying, don't buy US products, buy Canadian, right? And so when you have these trade wars, it does start to put the walls up and make people want to look elsewhere in terms of what they're buying. On a national level, when it comes to the buying of US treasuries, it's questionable as to whether that will or won't make an impact. But certainly we're in the midst of all of this crisis. There was talk of Japan, the biggest holder of US treasuries outside of the US, trimming back their holdings in a bid to essentially use that as a ploy against the United States. Now, of course, you're also seeing the likes of the Chinese that could potentially use alternate methods, because, of course, they were talking about the idea of withholding the export of rare earth materials. And so some countries will utilize it as a means to be able to essentially manipulate those trade conversations. And those trade conversations are not resolved, right? We've still got these 90-day reprieve periods and the talks are ongoing. I haven't actually seen a single breakthrough in terms of the US with a major trade partner where they have a big deficit to them. Of course, the UK is an easy win because they have a surplus, but it's different when you look at some of these other countries. And so that's where that rest of the world piece comes in. And so it brings to mind whether treasuries are actually a haven right now, and the perception around whether, at times of concern within markets, people still go into treasuries as they have done in the past. And what we can see here is that the last time that we saw a sort of credit downgrade, the S&P 500 credit downgrade in 2011, you could see on the left-hand side of sort of, it's not that bold, but you can see that sort of purple zone there that you've got, which highlights that point in time where essentially we saw that downgrade and we saw a sharp decline in terms of the yields associated with the long term in terms of the 10-year yield, but also the likes of the 30-year yield as well. So essentially, you're looking at weakness in terms of the yield, which points towards people demanding more US treasuries as a haven asset at a time where they're seeing the credit downgrade. What's happening now? Yields are moving higher. So the credit downgrade comes with people moving away from treasuries, right? So that is a significant shift in terms of tone. So that brings us onto this chart, which highlights the Fed balance sheet compared to US debt. So if you want to ramp up debt, a lot of the time you need to create that demand, and that can come through the Federal Reserve in terms of the likes of quantitative easing. We've seen it in the past, QE1, 2, 3, and we saw it during COVID as well. Massive spending packages coming in times of need for the economy, and that goes hand in hand with the creation of debt and the expansion of the Federal Reserve's balance sheet. So will we need to see the Federal Reserve step in to provide that demand if we don't necessarily see the foreign demand coming into play in the way that the US would need? That remains to be seen. But of course, debt to GDP, you're seeing increased debt ballooning at the same time that we're seeing the balance sheet at the Federal Reserve coming into play. And so are we going to see that same thing happen again? Now, equity markets have been moving low at the beginning of this week. There's some fears around what this might do in terms of sentiment. People become fearful that essentially the US is going to have a crisis, a fiscal crisis, or a financial crisis. I don't necessarily see it that way. I think if you look in the past, if we did see another form of stimulus from the Fed coming into play, that could be a massive boost to equity markets, boosting liquidity within the markets. And we've seen it in the past. When you see QE packages, it generally boosts equity markets. We don't necessarily know that the Fed are going to step in. And key to that is going to be inflation. Right now, we're seeing the Federal Reserve unwilling to really even provide much by way of rate cuts. If you're looking towards the back end of the year, we're seeing some comments at the beginning of this week already about the idea that we might only see one more rate cut this year. So it's not a given by any stretch of the imagination. But if we were to see increased pressure being put on in terms of potentially higher yields or in terms of a lack of demand, and the two are likely to go hand in hand, if they need to sell these products, then there's a chance that we see the Federal Reserve step in. Could it be something like QE? Perhaps. Could it be something that's not QE but provides additional liquidity? Probably more likely, quite frankly. QE is something that generally has been utilized in the past during times of absolute crisis. So it doesn't really look like a particularly good look if you're enacting QE at a time when supposedly you're not in the middle of a recession or a crisis. But certainly they might come to the point where they need to up the liquidity and up demand for US Treasuries. That might be the case of stepping in to buy one form of Treasuries and then sell on more liquid ones, things like that. But it remains to be seen. But certainly a potential end to QT, which is currently underway. It's a slowing of the QT process underway at the Federal Reserve, could soon give way to increased liquidity and expansion of the balance sheet under the Federal Reserve. And that by and large is good for equity markets, despite the fact that right now people are saying, look at what the Moody's downgrade, that's, bad for equities. Not necessarily. Ultimately, this debt has ballooned over an extended period of time, and that will probably continue. And that theme certainly should be worth noting, and that's what we're talking about today. Does it mean that suddenly the equity markets are going to crash? Certainly by no means, because ultimately it's just increased borrowing, right? And so you can continue to borrow. It is a problem, but until the wheels fall off this thing, it is still something that the equity markets are probably going to benefit from. But when it comes to the US dollar, it does potentially undermine the US dollar. And certainly what we've been seeing here recently, and you can see it, is the disconnect that's developed between the US dollar and the 10-year. So essentially yields in the US dollar generally go hand in hand because you have that essentially haven role that is played between the US dollar and between US treasuries, right? So essentially the US is a haven. But right now, people are questioning whether it's a haven. And at times where we're seeing that upside coming into play in terms of yields, we're instead seeing fears around the sustainability of the US debt, and it's driving down the US dollar. So you can see here the sort of symbiotic or the positive relationship and correlation between the US 10-year and the dollar index appears to have broken recently. So whether that continues or not remains to be seen, but it brings us onto this first point of call, which is essentially the US dollar. So let's just jump into the charts and we'll look first and foremost at the dollar index. This is a long-term chart. So you can see that from a long-term perspective, we're still within a bullish trend. But we certainly have been in this state of flux where we've seen it falling into the lowest level in April, the lowest level since April 2022. So a 3-year low for the dollar index. Now, we tried to regain some ground here, certainly when we started to see the announcement around the sort of US-China issue being temporarily resolved. But we're starting to roll over once again here. And certainly it does highlight this sort of wider trend that's in play with this trend of lower highs and lower lows. And we've been rebounding, but there's been question marks about, are we within this retracement phase before the bears come back into play once again? Let's look from a trend line perspective. Do we have any sort of trend lines to note? Yes, we do. Do we have any Fibonacci's worth noting here? So just shy of the 61.8. So you've come into a relatively deep retracement alongside trendline resistance that's held, and now we're starting to roll over. Like I said, if we put the sort of US 10-year, we can put the 30-year on as well, but we can just use the 10-year. So this is the 10-year yield overlaid. And so, like I said, we've got this sort of divergence where we're seeing a rebound. So you can see here the higher high coming into play here for US 10-year yields. And that's not necessarily following perfectly with dollar index. Yields rising at the moment, the dollar index rolling over. So we're sort of in this interesting state of flux where sometimes it comes back into positive correlation and other times it loses that correlation. So you can see that here, right? We lose the correlation here. We're losing the correlation here where this goes higher, that goes lower. Then we come back into positive correlation. Then we come into negative once again. So it's very interesting to see how this correlation plays out. And certainly around the Liberation Day, that's when we really saw that divergence develop, where we saw that sharp rise in terms of the 10-year yield, the decline in terms of the US dollar. So quite whether that's going to continue remains to be seen. But certainly if we see continued headlines around the debt sustainability issue over in the US, I think that's a potential driver of downside for the US dollar going forward. Let's just get that 10-year yield off. And so we're talking about this as a potential area where it could roll over once again and play out within that theme that has of dollar weakness that's been dominating this year thus far. But the 4-hour chart does highlight this recent recovery phase and therefore a breakdown through this swing low that, let me just put that a bit more accurately, there we go, of 99172. If we break through that, then that's going to give us much more confidence that this has held and that we've rolled over and we're going to head back in through that low and continue on this bearish trajectory. As it stands, we've come back into the 61.8 on 2 occasions and now starting to see a bit of strength. But certainly it's going to be a really interesting one to watch if we see continued issues arising around the debt sustainability in the US. And of course, the bill in the US is going to, the big lovely bill, or whatever Trump calls it, a beautiful bill, is going to be a key test of that when people are talking about what that means for the US debt. The next point we want to talk about is gold. And I think this is likely to be one of the big benefactors if we see this as a main theme within the markets at the moment, right? I think interestingly, if we're looking at sort of the potential benefactors of a feeling that the US is no longer a sort of reliable place to do business, certainly when it comes to treasuries because of the debt issue, then you look generally at sort of non-fiat things, because you've got the potential for them to try to erode away the debt that they have through higher inflation, potentially issuing, issuance at their Federal Reserve, so increasing their balance sheet, things like that. So it's devaluing things like the debt, devaluing things like the US dollar. And so generally that whole narrative plays into the theme around non-fiat assets. So that would be the likes of gold, that would be the likes of crypto. And of course, we've seen Bitcoin at 103. We've seen gold gaining ground, but then more recently sort of rolling off. So it's an interesting one because I think that narrative really plays into both of those assets. But at the same time, one of them is a risk-on asset in terms of Bitcoin. One of them in terms of gold is a sort of risk-off haven asset. So we're likely to see fluctuations between those two. But, gold, I think, is the one that's worth focusing on here. Because what we have seen here is that central banks have been starting to stockpile gold over US treasuries, right? And that's why it plays into this same narrative. And we can see that here, right? Accumulation of gold at central banks on the bottom end in terms of the histogram. And then we can see the line represents the treasuries being held, US treasuries being held by foreigners, essentially, foreign holdings of US treasuries declining over recent years. So that is a trend that has generally been something that was sort of kicked off by the BRICS nations, or certainly over recent years by BRICS nations, but we're seeing that spreading into other areas as well. Many countries around the world are sort of starting to stockpile gold over US treasuries. And, what we have seen recently in terms of gold demand is that we've seen significant central bank purchases. And if you look on the left-hand side of this chart, the sort of darker green at the top end of each section is the central bank purchases. So you can see on the right-hand side is much bigger, chunkier prints compared to on the left-hand side. So much more significant central bank buying of gold. But we've also seen a significant jump over the last quarter or the first quarter in ETFs. So that's sort of retail and institutional money coming into gold as well. So you're seeing sort of central banks and the financial sector both moving into gold over the last quarter in particular. Notably, this is it's an interesting chart also because it highlights just how important the jewelry industry is to gold demand. But whilst you see fluctuations, it's not necessarily something that is going to be impacted to the same degree as some of these other things like central banks and ETFs or retail and institutional. So as we see here, record central bank gold purchases over recent years, continuing to climb, going hand in hand with upside for the price of gold. So really benefiting that safe haven play. Like I said, it's not necessarily a one-way move at the moment, because you do also have the fact that gold is perceived to be a haven. And so when markets are feeling all hunky-dory, people aren't necessarily desperate to start buying into gold, right? But my point is that, you're going to have jitters around this narrative. The Moody story has sort of brought it to the forefront once again. But when I think about the different drivers of sentiment and market movements, you've always got to be able to look at the different drivers and try to separate one from the other. Which one's going to actually have a tangible impact, which one's going to be long lasting, which one's a short-term blip, right? So for instance, when you're looking at an economic calendar, you might see something and say, oh, look, the US inflation figure's done this, or the German factory orders has done that. You always need to question whether, is this a change? Is this a part of the same narrative and just doubling down on that? Is this something that's going to be short-term in nature and therefore it shouldn't make a lasting impact? Is this something that makes a tangible difference? Is this the beginning of a new norm? These kind of things are really key. But I think that underlying beneath, the question marks over what's going to happen in terms of the Federal Reserve. Are they going to cut more or less? And how's that going to change? Or what's going to happen in terms of trade relationships? One day they're good, next minute they're awful. You could see Donald Trump any day suddenly put tariffs back on. What's going to happen with the geopolitical situation? India, Pakistan suddenly kicks off. Russia and Ukraine, how's that going to get resolved? Iran. So there's all these different things that are likely to change from one day to the next. It's just, in my mind, I think that the US debt issue just isn't going away. They're not suddenly going to be able to reverse it. How it might change is that they might get the Federal Reserve involved to be able to increase liquidity, increase demand as a means to solve some of their problems in terms of trying to drive down yields and in terms of trying to sell some of the treasuries that they're issuing this year. But that sort of plays along the same narrative. I just don't know how this narrative goes away in terms of actually reversing it to a point where people don't really care anymore. So that's why I think this is a particularly interesting theme. Now, if we're looking here in terms of gold, you can see that we have pulled back of late, and that's kind of gone hand in hand with the sort of more positive outlook that's come into play with the whole China issue here. This is the S&P 500. Well, it's inverted, as you do. And so you can see here, we've seen the sort of pop in the S&P 500, and then that haven demand for gold really starts to dry up a little bit. But there's some question marks right now about whether the S&P should be at record highs or getting back towards record highs. So, for me, I think, we've seen this sort of ABC style retracement, that Elliott wave style retracement in gold. I think there's a good chance we've bottomed out here between the 61.8 and the 76.4 fib. Are we seeing something over the short term that highlights that that's the case? Well, you can see here that we've got this sort of zone here where that would be the neckline of an inverse head and shoulders formation. Right, so it'd be like that. So I don't necessarily utilize the break of the trend line so much as the break through the prior swing high. So on this occasion, I moved through 3252 and then in particular 3265. But yeah, if we start breaking through this zone, then, it's even greater confidence that this is the bottom. But we have got this inverse head and shoulders formation that could complete in the coming days. But certainly, this narrative around the debt sustainability question marks over in the US that's driven the downgrade points towards a potential for weakness for the US dollar, but in particular, it highlights why people are stockpiling gold over US treasuries. And I don't necessarily think that trend's going to go away. It might slow down if we do see this sort of trade war peter out and we don't necessarily see this massive sort of tit for tat trade war that we had been fearing for a while. But I do think that narrative and that theme is going to be a long-lasting one. It's not going to go away, and that does provide the basis for potential strength for some of these non-fiat assets, such as gold in particular. So that is one of my sort of main themes, and it had been coming into recent years as well. It was somewhat predictable that we were going to see rate cuts, very predictable. Generally, we don't see, so generally we don't necessarily see cuts that are that predictable because it comes with an economic crisis. So all of a sudden, people suddenly start to price in the need for cuts. Whereas this time around, they were sort of forced into hiking to drive down inflation. Therefore, the cuts were expected. So I thought that was going to drive up gold. And now we're coming into this theme where people aren't necessarily that confident around the US treasuries as well. So gold remains attractive for me. And I think this debt sustainability issue just provides that backbone behind the bullish gold story. I hope this has been useful. As ever, make sure to like, subscribe, and follow us for more content here at Scope Markets. My name is Josh Mahony, Chief Market Analyst. Have a great day and good luck trading. Thank you.